The Fed is hiking rates again, and probably 3 or 4 more times for the rest of the year. So what does that mean for you as a home buyer? Let's talk about it. What is going on? It is Andrew Armonger with the Emerald Group right here in sunny Florida. We actually service everything from Pensacola and Panama City Beach and everything in between. So if you are moving to this area from, anywhere, and you want to reach out to us, you have any questions, please let us know. All of my contact information is on the screen. And if you are trying to figure out everything there is to know about the Emerald Coast, you've definitely come to the right place. So go ahead and hit that subscribe button and make sure you tickle that little bell so that you'll be notified every single time we do a new video. Now, let's jump right into it. The Federal Reserve is hiking rates again. Okay, they've got to do this, right? The inflation is through the roof. It's something like 8 or 9%. I didn't even look at it. It's insane. And the realistic number is probably closer to 11 or 12. We just haven't caught up yet with all the data. So, well, what's the government going to do? They're going to need to do something to hedge against it. So this is what they do. They hike the rate. And when they hike the rate, the interest rates for mortgages tend to follow suit. They technically follow suit with the 10-year Treasury bond, which I'm not going to go into all the details. I know I've talked about it a couple of times on this channel, but the main point is that the Federal Reserve is going to continue hiking rates probably 4 or maybe even 5 times this year. Now, they talked at one point about doing it 11 times, but that's probably unlikely. But what's not unlikely is the next few hikes that they're going to make. As I'm shooting this in the first week of June, the interest rates right now are hovering around 5.5 to 5.54. Okay, so it's not that big of a wide range, but that's kind of the average across the board. You'll find some that are a little bit lower, and depending on your product, some that might be higher. So sitting at 5.5, let's call it for easy numbers for the rest of the video, as the Fed continues to hike the rate, those interest rates will follow suit. Now, they might not follow suit in the exact same way. For instance, the Federal Reserve hikes a rate 50 basis points or 0.5%. That does not necessarily mean that we will get a 0.5% interest rate hike, but it does tighten up lenders a little bit on their margins so that they've got to be a little bit more competitive. So what we're going to talk about in this video is, first, if you're in the buying market anytime in the next 6 months, what you need to do in order to make sure that you're getting the best rate possible. And we're also going to talk some tactics and tips and things like that you might want to use in the future if maybe you're buying a little bit later. We know that a big majority of this channel are home buyers looking to move to this area, or really, anywhere in Florida. Sometimes we get a little bit of trickle over. So we want to make sure that you guys are prepared as much as possible. So let's start by taking a no kidding look at what this is probably going to look like. Now, nobody has a crystal ball. I want to emphasize that before we get into this. I don't want to see a bunch of hate comments saying that I'm predicting the future. I'm not. I'm just giving you some realistic scenarios of what could happen. So as I mentioned before, the interest rates are around 5.5. So let's say that they get up to around 6% by the end of the year, which is fairly conservative. That's probably a little bit higher than it might actually be. But the fact that we jump so high already makes me think that we might even climb a little bit higher. But just for easy numbers, let's say that we land the end of the year, or quarter 4, at around 6%, just for easy numbers. So let's take an average home in our market at about $300,000. Now, I know technically our average price point is just a hair higher than that, but not much. So we're using 300 for a nice, easy round number. The actual average for us is around 330, but again, let's use an easy round number at 300,000. At 5.5%, you can expect, with taxes and insurance, your payment to be somewhere around $1,764 plus or minus a buck or two, okay? Once it jumps up to 6%, let's say in quarter 4 of 2022, that same home, if prices didn't change, which we'll talk about here in just a moment, would be $1,840, assuming that taxes and insurance are the exact same as well, just to put everybody on an even playing field. Now, that's not a huge jump, but that is a $75 difference a month, which in turn is like, what, $900 a year? Now, that's not a lot, but it does matter, right? Especially when you're trying to calculate, hey, I'm moving to a new area. What does cost of living look like? How much am I going to need to spend? What's everything going to look like? This is a pretty important piece of that puzzle. And that is, of course, if we only go from 5.5 to 6%. I have this sneaking suspicion we might even creep a little higher than that, although I can't find any reputable experts to follow suit with that. So I guess we'll see what that actually entails later on. Now, before we go too much further here, I do want to emphasize that we're going to try to use realistic numbers for all of this, not the crazy teaser rates that you might get from some online lenders. Keep in mind that if you Google the best interest rates, you're going to get some pretty low looking stuff. In fact, it wouldn't surprise me if you still saw stuff in the threes, but that is a teaser rate to get you into and onto their website, and it doesn't include the 15 basis points you're going to have to buy down or anything like that, which we will talk about here in just a minute, and some strategies that you might be able to use to lower your interest payment if it makes sense. So let's look at first, what can I do to make sure that I don't get this astronomically high 6% or 6.5% interest rate? Let's pump the brakes just a little bit and talk about the fact that that's still historically low. Okay, I'm in real estate sales, so take that with a grain of salt, but realistically it is. Over the last 100 years, if you look at the average, it's somewhere around 8 or 9%. So 6% in my eyes is still a steal. Now, markets have changed, the country has changed, a lot of different things have changed, so maybe we shouldn't use a historical average. Okay, great. 6%, still not that inexpensive to borrow money in the grand scheme of things. But let's say that you do want to go ahead and make sure that you're getting it as low as possible. Let's talk about some other options you might have that you could utilize to your advantage. So the very first tip I have for you is this is a great time to be shopping lenders. Now, I think you should be shopping lenders no matter what the market looks like, because you just don't know what it looks like or what interest rates you might be able to get. This is a really good time in particular to make sure you're talking to a couple of different people so that you're getting the best rate possible. But not only the best rate, you want to make sure that everything else is in line too, that the fees aren't too high or anything like that, because if the fees are high, well, you're going to be losing a lot of your money up front and gaining it over the next 5 or 6, 7 years, and that's probably not the best strategy. But nonetheless, shopping different lenders is going to give you a bigger perspective, and you're going to have wider products to be able to use. Remember that loans are a product like anything else, like something on the shelf at Walmart or Publix or wherever else. You go there and you shop for them. There's 5/1 ARMs, 7/1 ARMs, jumbo loans, VA, FHA. There's specialty products. There's a portfolio loans. The list goes on and on. So you want to make sure that you're shopping different options, especially if you're having to put a large down payment down anyway. You're going to have a wider range of products to go through, and you might be able to find something that's just a little bit better for your situation. Okay, so you've got a great lender. What are your other options from there? Well, buying down points can definitely be an option, but I think you should run the numbers to make sure that it makes sense for you first. So let's go ahead and take the same example I used earlier, that $300,000 home at 5.5%. Let's say that you're buying it right now. Interest rates haven't hiked yet. Your monthly mortgage payment, taxes, insurance, everything, if you put 20% down, would be the same as before, $1,764. Now, if you buy down 1 basis point, depending on yield where that's at, I'm not going to go into the details there, but let's just say 1 basis point is 0.25% off. 1 basis point meaning you're going to be paying 1% of the purchase price in order to get that lower interest rate. In this case, it's a $300,000 home. You pay $3,000. You get 0.25% off your interest rate. This seems like a good deal. It's going to knock down your payment down to $1,726, a $38 savings per month, every month for the life of the loan. Well, is this a good deal or not? Let's divide that $3,000 by 38. That's going to give you approximately 79 months. That's how long it's going to take you to pay off that $3,000 extra dollars you paid for the lower interest rate. So that's 6.5 years to recoup your funds. If you're buying your forever home or you're buying someplace that you know you're going to be sticking around for a while and you're very certain you're not going to want to move or upgrade, your familial situation isn't going to change, and it might be worth it for you. If you spend 10 years in it, you've saved a little bit. I don't know if the risk is worth it personally, but it definitely is an option. And you can keep running these numbers for, any of the situations that make sense for you, but that's approximately how it's going to go down. So a lot of that is just going to depend on your situation. Okay, so maybe buying down the rate isn't the best option. Maybe it is, who knows? But there's some other options too. You could go with a different product. Let's say an adjustable rate mortgage. Now, I'm going to emphasize this. I am not a big fan of adjustable rate mortgages. Back in 2008-9, during that time frame when everything was kind of collapsing and the world was going crazy, about 2 out of every 5 loans were adjustable rate mortgages. Lucky for us now, only about 1 in 100 are. Now, I'm not saying adjustable rate mortgages are bad. In fact, in a lot of situations, you may not have a great choice because a 30-year fixed might not be an option, particularly with condos and vacation homes out here in the panhandle of Florida. Reason being is because they need stricter guidelines, and Fannie Mae, Freddie Mac may not be able to match those. So you might have to get a portfolio loan where an ARM is your only option. Now, when done right, an adjustable rate mortgage is not the end of the world. It's not that big of a deal because you can refinance before the adjustable rate portion happens. Because I'll tell you this, they're called adjustable rate and they say the rate can go up or down, but they don't go down. Historically, they never go down. They only go up. Obviously, it benefits the bank. They've kind of got you by the coattails, so why not make a little extra money on you whenever the, fixed portion of your loan runs out? But that being said, if you watch it carefully, you keep your credit up, you do everything you need to do, and then you refinance later, that could be a very credible option. And of course, if you don't have a better product you can use, this might be your only option. Again, not the end of the world, just try to watch it carefully and make smart moves as you're progressing through time. Okay, maybe you don't want to do an adjustable rate mortgage. I completely understand that. What about a 15-year fix? That could be an option. It would definitely lower your interest rate. You might get an entire point off. And, that could be a good option for you, although it's not one that I am a big fan of. So definitely talk to your lender, talk to your real estate professional, talk to your CPA, what have you, to make sure it makes sense. The reason why I'm not a big fan of 15 years is because you can do the same thing at 30 years and just double down your payments or pay what the 15-year would anyway. The change over 10 or 15 years is fairly nominal for the fact that you're already paying that extra, so you're buying it down quicker, and the interest rate, sure, it's still there. But if it's an extra 30, 40 bucks a month for 10 years and then you pay it off, then, well, realistically, how much money did you save? And that's a lot to ask of you because you're going to be fixed there, right? It's going to be a little bit harder to refinance into a 30-year or something like that. So if you're going to get tied into a loan, a 30 year is generally better because what happens if? That's the game we're going to play here. What happens if you lose your job or your pension or an investment that you've got going on, or just life happens? Sometimes life kicks us in the teeth. It just is what it is. You don't want to be stuck into this mortgage payment and risk foreclosing on it or having to short sell it down the road when you could have been just fine with a 30-year loan. It's going to be hard to refinance if you lose your job or any of your money or anything like that. So please keep that stuff in mind. Be very confident before you do a 15-year. At the end of the day, though, it is a lower interest payment. So if that's all you're worried about, that is definitely a good way to do it. Another option you might have, and this might be all over the place depending on the product that you're purchasing, but putting down a larger down payment could yield a lower interest rate. This could put you in a bracket for a different product which has a lower interest rate already, or it might just be part of the plan. Hey, if their credit score is a certain amount, they get a certain amount, and if they pay down extra, we're going to give them a better interest rate because that shows that they're more invested than we are, and that reduces some of the bank or the investor's risk. If it's not a bank or a portfolio loan or something like that, it reduces some of their risk, so in turn they're going to hand over a little bit of that to you. So that could be another option. And the last tip that I have for you guys is kind of a big one, especially if you're purchasing in the next 6 to 8 months. And that is, as the Fed is hiking the rates, they're planning on doing this June 15th, July 15th, August 15th, and probably September 15th. And we don't really know what it looks like after that. They're projected to do a few more. If you're able to get ahead of that and get your pre-approval done and your rate locked in earlier rather than later, that is the move that you want to do. Now, keep in mind, you're going to need to time this, okay? So if you're planning on purchasing by August 31st, let's say, and that's an arbitrary date that I picked, let's say that that's when you want to be closed and done, but your closing date's going to be around August 1st, just to give you some wiggle room, okay? Well, most pre-approvals are going to be good for 3 months. Make sure you talk to your lender first, or the lender that you've decided on after you've shopped around and everything else that we talked about, right? 3 months is generally how long they're good for. You can actually lock in the rate ahead of when you're going to purchase. So I would do it before the June 15th rate hike. Go ahead and lock in on the 14th or whatever day makes sense. Talk to your lender about this because they know things about like where the yield is at, and if the yield is a certain way, it might be better to wait a couple of days if they think it's going to drop down, or vice versa. Talk to them about it. Most good lenders are going to be able to walk you through that. But point is, do it before that big rate hike. Now you'll be locked in and you'll have 3 months to close on a property, and then you can generally buy back some of your time if for any reason it extends. But that's very important to note, is that you don't want to book it all the way up to the end because things happen in real estate. Sometimes closings get pushed and things like that. You don't want to jump out of your rate lock, not have an option to buy back into it, and then have this much higher rate or higher than you were originally expecting. If you have the ability to purchase earlier rather than later, this could save you money in the long run, okay? So if you know you're going to be closing, let's say in December of this year of 2022, but you can afford to hold on to a mortgage for 3 or 4 months, then buying early might save you. It might take you a couple of years to recoup that money, but having a 0.5% interest rate better, well, that will yield great results in the long term. But just run the numbers to make sure it makes sense. And for those of you that cannot afford to purchase earlier, maybe you need to sell a house. I mean, there's 100 different situations where you can't do that. Well, the best thing to do then is just grit your teeth and run through it. And that's not a great response. I'm sure you wanted like some sort of like, I don't know, great solution for that, but there might not be one. Now, before we wrap this up, please keep in mind that we do have buyer and seller guides down below in the little, remark section there. So if you are thinking about buying and a guide would kind of help you along with that, we do have a lot of great little tips and stuff like that we don't generally talk about on the channel. You can always download those. They're free. We're not charging anything for them or anything like that. They're just for you guys to have. And other than that, that's everything I've got for this video. I really appreciate you guys watching, and I guess we'll see you next week. See ya.